Hi viewers, I am Dr. P. Uday Kumar, Professor in the Department of Computer Science and Engineering. And today I am going to discuss about budgetary control. And this is very important concept in principles of management. Normally, budget and budgetary control required for every organization, how the money is involved. That is, they are going to spend the money either yearly basis or quarterly basis or long term, right? And how they get the profit. So, budgetary control, the clear definition is budgetary control. It is a financial process that involves regularly comparing actual income and expenses. So it is a method of managing cost and ensuring that organization financial goals are met. That means finally it leads to profit, right? So once the profit is more, then again we can put more budget also. What are the salient features? First, objectives, then activities, plans, performance evaluation, and control action. Determining the objectives, right? And why we put that budget, and what are the different budget levels are there, whether it is short term or long term or fixed or flexible, like that. Then activities, how you spend the budget in various activities, then how you plan for that, right? As I said, a yearly basis or even monthly basis, like that. Then performance evaluation. Once budget and everything is there, and you have to compare, right? How the budget is reflected, based on that, what input we have put. Then finally, the control action, ensuring that when the plans are not achieved, then corrective actions are taken. Initially, we have invested some money, right? But that money is not used for that purpose, right? Example, for new plant, we have invested the money, budget is allotted, but that is not coming into operation. Then what are the corrective measures to be taken? Classification of budgets. We know that it's a long-term budget as well as a short-term budget. Long-term budget more than 1 year or 2 years, 3 years, like that. Short-term budget is just in 6 months or 1 year, less than 1 year. Then conditions, basic budget, then current budget, capacity, fixed budget, and flexible budget. Fixed budget, for example, salary, yeah, employee salary. Every year it's almost fixed. Only very slight variation will be there, 5% or maximum 10% variations. But flexible budget, always flexible, even 20%, 30% variation also will come, right? For example, money utilized for purchasing the vehicles, like that. Then coverage, functional budget and master budget. Initially, the master budget is used to establish very initial level, because it will reflect overall expenditure. It is a combination of all budget. Now, long-term budget, prepared for a very longer time. Example, R&D budget. So even we can plan for 2 years or 3 years, like that, or even we can put that budget for uh, launching of satellite, for example. So it will take 2 to 3 years for coming into operation. Then short-term budget, less than a year. Normally it is about 3 months or 6 months, like that. Then example, cash budget. Then basic budget. Some budget remains unchanged, right? It is, we can say it is a fixed budget. Then current budget, related to current conditions. What are the today's conditions? Then some changes are there, right? Most probably it is based on monthly. Then fixed budget remain unchanged, as I said, some salary of the employees, right? Then flexible budget, various budget on different levels of activity, right? So some, for example, sports, right, or the medicines, or insurance, or something like that. It is used. functional budget for the individual functions in an organization. Mainly, it is for the operational purpose. Then master budget, it will reflect the overall expenditure like a profit and loss account. How much profit is there and what are the loss percentage, like that. Then budgetary control techniques. What are the various techniques? Number one, revenue and expense. Revenue in the sense, what are the income? How you get that? For example, after sales, you are getting income. Then expense, right? Expenditures, even salary, these are not expense. Even when you see that unit budget also, it is like that only because of how much revenue they are going to get, and out of that how much expenditure. And we cannot tell that revenue is 1 rupee and expense also 1 rupee. It is not like that, right? Some variations will be there. Time, space, material, and product budget. Many budgets are better expressed in quantities rather than in money terms, right? Quantities, for example, time, right? How much time it is required, whether 3 months or 6 months, like that. Then space. Suppose you are purchasing the equipments and where you keep that equipment in space. So space is not only for operational, even the space is used for inventory. Then material, what are the material you are going to purchase, right? It is nothing but raw materials, right? And also the product. What is the main product is manufactured. Then capital expenditure. Capital expenditure is the very initial level, and without that, then organization cannot survive, because every organization they have to put some level of money for the capital. Capital is initial money is invested. So it is for the plant or machinery or equipment or inventory, right? So these capital expenditures, so directly they cannot go for the profit because it is invested, and it will not come for the profit and loss account. Because, for example, initially you have invested for 10 crore for plant, machinery, equipment, like that. And the first year you are getting profit of 1 crore. So it doesn't mean that you are going for 9 crores loss, like that. So capital expenditures, it is for computer for long-term investment. Then cash budget. This is a regular forecast, right? And cash receipts you are giving. And similarly for variable budget. So it even the fluctuations will be there. It is not fixed, right? The money utilized for purchasing a vehicle, like that. Similarly, zero-based budget. Initially, all the organization initially they will start with zero. Zero means just zero, and then one, two, then again 100, then crores. It will go to crores. Then that means basic is zero. Then non-budgetary control techniques. Budget is in leads to amount. What are the non-budgetary controls? Right, that is directly not related to budget or not related to money, but it is a statistical data. Right, different levels of statistical data we are using. Some chart, directly we can sort chart or break-even analysis, how the performance of the organization, right? Directly we can put that chart, and easily we can analyze, right? For example, sales. And so sales department or marketing department, how the marketing happened last compared to last year or last 3 years, last 5 years. Then operation audit. This is internal audit and external audit, right? So that they will keep on checking the cost regularly. Then personal observation finally. So one should never overlook the importance of the control of the personal observation. I already discussed about the different chart, and the number one is PERT chart. PERT is program evaluation and review technique. So one should never overlook the importance of the control through personal observation. Another one is Gantt chart. This is easily. So once the chart is prepared, so that based on that observation, then we can come for the conclusion, right? Thank you very much.